Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, and welcome to the Monday edition of 7 Investing Now, or the 5 in the morning edition, because we are taping, of course, with Anirban Mahanti. My name, of course, is Daniel Brooks-Klein. I am the host of the program. We take a look at some of the investing news of the day and put a long-term perspective on it. Anirban, how are things over in Sydney, Australia?
Oh, things are getting better. We're getting out of lockdown. Schools are opening today, which is why we are doing this at 5 a.m. for me, so that, I can get on with organizing the school day. But yeah, things are looking better, but it's still dark outside.
I had to explain that to my wife. I said, it's the first day of school. And I'm like, well, it's probably not traditionally the first day of school. It's the first day of post-lockdown, but time is meaningless. Everything is very strange. The perspective, you are either drinking a very tiny cup of coffee or that is an espresso. I am not sure, but we're going to talk about Tesla's recent earnings. And I'm going to throw out some facts and figures you put into an article, and I'm just going to let you riff. I'm going to sit in the background a little bit more than I usually do. So Tesla's gross margin hit 30.5%. That was driven by higher volumes out of Shanghai, more Model Ys, more Model S's. Are those good numbers compared to other automakers?
Yeah, so those are excellent numbers. Excellent in the sense that, if you think about what the other automakers, things like Toyota does, high teens in gross margin. GM does, 12%, 15% or so. So, of course, there's Ferrari, which does close to 50%, 55%.
Well, when you charge $200,000 per car or whatever it is, there's some room for margin there.
There's some room for margin. So it's not quite like a Ferrari yet, but it's very much industry leading otherwise for mass market production. So yeah, it was a fabulous number. 30.5%, very, very high.
Will margins get better as more factories come online? I mean, even things like you don't have to move cars as far to deliver them.
Yes, so that's a great question. So as they get on with their continent per continent strategy, and some of these factories are still not at full speed. So when these factories get to full speed, there is some margin. They're taking costs for things that are not yet producing things. Let me put it this way. So yes, there is some margin expansion opportunity for sure. So yeah, that's pretty exciting. Can Tesla get to Ferrari-like margins while being a mass producer? That would be very, very interesting.
That's a challenge, because if they're going to go with cheaper, like lower end cars, a true, say, $30,000 car, even to compete with like a high end souped up Toyota Corolla, you're not going to have the same margin as if you're selling like $70,000 pickup truck. So it's really going to be a question of where the volume is. But it is very impressive on a relatively small amount of cars that they're delivering. And still hundreds of thousands, but not, it's not 4, but it's also not millions that they're delivering these numbers. Cash flow has gotten pretty solid as well. So in the most recent quarter, they generated a free cash flow of $1.3 billion. And income from operations hit $2 billion. This was a company that not that long ago, we were worried about cash flow. Like, we were talking about, are they going to have to do like an uncomfortable cash raise? Now, they did some comfortable cash raises, some sell some stock when things were great just to put some cash in the bank, which is I actually wish they had done more. But are they at the point where that's just not even relevant, where they're just operating on a cash flow basis profitably, and we don't have to worry about the sort of like, oh my God, is Tesla going to run out of money, which maybe was always a false narrative?
Well, I think right now they're the king of the hill in many ways, right? So they're very, very cash generative at this point. So the free cash flow, they increased CapEx. So they've pushed up their CapEx to about $1.82 billion in that range. So they're putting money on the ground and generating a lot of return out of that money that they're putting on the ground, and that's going great for them. Then I mean, as you rightly pointed out, those cash raises that they did, their balance sheet looks like a tech balance sheet. Their net cash $14 billion. This is not like an automotive company whose net cash position will be like negative 50 billion or something like that. So they're in a very comfortable position, very cash generative. They retired all their heavy interest. They're basically in the process of retiring all their debt that they were paying like extraordinary amounts. There's an interesting aside here. The interesting aside is that their debt, which is very minimal at this point, is still rated as junk. Which I think is fascinating. I think they're waiting for their debt to become rated at like have an investment grade rating where they can get borrow at really low rates, and they'll probably yank up the debt profile at that point.
So they're sitting on about $14 billion in cash. Is that just going to get plowed back into the business?
I think, companies have experience, this is my guess, based on their so-called near-death experience from the Model 3 ramp. I think this is a company that's going to always carry tens of billions in cash on their balance sheet. But they are going to generously put from the free cash flow that they're generating. There should be even more free cash flow generative in the fourth quarter of the year. They're going to put that back into the factories, right? There's already two that are coming. The big one coming at Austin. They've moved their headquarters to Austin, and then the big one in Europe. There's already lobbying going on as to whether India gets a factory or who else gets another factory. I wish they don't actually build one in India. India doesn't have a very good track record of actually attracting companies and having them build factories and then actually having them turn out. Ford actually is closing its plant in India for all sorts of different reasons.
You drive a Tesla. Where do they ship that in from?
So mine actually got shipped from Fremont, but all the ones that are now shipping into Australia are actually coming from China, Shanghai. So Shanghai has actually been doing the bulk of the exports. The Shanghai has been holding that, and whereas Fremont has been mostly just serving now North America because the demand has just been that strong. So Fremont is no longer exporting, which is why if I want a Model S, I actually have to wait until 2022 to get one. I can't get one. Even if I want to spend that money, this is a unique situation where you want to spend the money, but you can't get it.
So let's talk about demand. Every auto manufacturer has had like a vague press release or press conference where they lay out their plan to be fully electric by 2030, but the plan is basically just a press release and some model numbers. Tesla's actually doing it. Are they in a position to grow, not just because, hey, people love Teslas, but because sort of everyone is saying you need to be an EV, and they're kind of the most practical way to be an EV. Obviously, there are other players, but they're either niche players or like, I'm not so sure if I want like Ford's third electric vehicle. Like it doesn't feel like any of the old line companies, and maybe Volkswagen's an exception, are delivering cars that I necessarily want. Maybe Toyota will get there, perhaps working with Apple. But is this just a case of where like the market for Tesla is going to meaningfully shift? And will that be a lease market, not a sales market because of the price point?
These are great questions. So I think if I look at the broader landscape, the demand. So there was a comment from the CFO in the call. And by the way, Elon Musk actually gave the call a miss, which made the conference call very, very much like a traditional conference call with the CFO almost behaving like a CEO or COO. So I really like this guy, Zach Kirkhorn. They should probably make him the CEO. But that aside, I think they commented that the demand has been so high that they've been taken aback as well. They didn't expect this kind of demand. So that's probably a turning point for EVs in general. As you rightly again pointed out, Volkswagen Group actually has probably the most credible EV strategy behind of Tesla. And I think they are going to be a formidable competitor in the years ahead. Some of the other ones are interesting because some of the other ones don't really have an EV strategy. They have an EV strategy on paper, which I've been saying this for a long time. I think many traditional OEMs are going to turn into contract manufacturers for big tech, because I think big tech is going to make vehicles for obvious reasons. Like so Waymo is there doing autonomy. Well, why wouldn't they make a vehicle which is contract manufactured by somebody else? Apple, we have been hearing these rumors of Apple talking with this person, that person, Nissan, Hyundai, Kia, Toyota, whoever, right? There's a lot of speculation. So I think Apple's going to make one with some of the, and it's going to be probably in either in partnership or contract manufactured by someone else. are vehicles going to be leases or sales? That's hard to tell. The lease is still a small percentage at this point.
It is. Oh, I only bring it up because from my, like I do financially well. My wife has a nice job, certainly not as nice as your wife's job, but like, we're reasonably comfortable. And I looked at the lease price for a Tesla, and it's a little bit more palatable to me than the purchase price for a Tesla. So it's like, it's something that if, 2 years from now, I'm doing like 15% better, or we don't live someplace that's crazy expensive, which we do at the moment. It's not weird for me to think about leasing a Tesla. I actually drive too many miles to lease a Tesla, but like the economics of it seem like it would make sense for like, I don't know what, upper middle income. I don't know how you define things. Like I'm doing fine, but like, people who might buy a new car, which is actually something I've never done. That's sort of why I brought up the leasing piece.
Yeah. So I think so the lease price here too seems more affordable. I mean, the only thing with the lease is I think a lease versus sales is also how it has got largely to do also with there is an upfront cost spending, of course, but there's also the question of total cost of ownership and whether or not, if you sold the vehicle, how much would you get, or if you traded in, how much would you get, and things like that that come into play. So I'm not sure. I mean, what the answer is I mean, I would just say I don't know. I don't know what the situation is going to be. But maybe if they go lower to smaller vehicles, I mean, their strategy is to go to large scale EVs, in which case actually they want leases because they want people to have the car, pay for it. Then when the car is depreciated 4 years, they take it back and they turn it into robo-taxi. That has been their strategy or plan. So if their plan is going to work out, that leasing is going to be actually their strategy of selling even more and make it very attractive. So I think that could have a relationship with robotaxi. Although honestly, I think the robotaxi is some number of years away. But yeah, I think the leasing fits in very nicely with the robotaxi strategy.
Yeah, and there could be an interim play on robotaxi where they partner with an Uber or a Lyft or somebody, and they take those cars and put them into a fleet. I think that could happen in markets in the US where Uber has to make people employees or quasi-employees. We won't get into that whole political debate, but right. There are some tipping points there. We talk a lot about maybe Apple going into the car space. We don't really talk about Tesla sort of quietly becoming Apple. Like this is a company that's also selling services. That's also, would it be crazy to you if I said like Tesla makes an anything in the next 5 years? Like, that Tesla quietly has like an AR division that we don't know about. Like it doesn't seem that crazy. Is Tesla becoming more of an Apple?
Well, Tesla does gaming already, right? Tesla's got games in the cars that, and it's got the new Model S's and the X's. They've got PS, 5 or 4 equivalent, processing capability sitting in the car for gaming. So Tesla has autonomy. Tesla is doing a lot in the artificial intelligence space. Tesla is doing a lot in the, in the energy space, especially with the virtual power plants and energy trading programs that they run. So it's very much a software company. The interesting comment from the CFO again on the call was that right now, they are not really recognizing much of the software revenue. Basically, right now it's a hardware play. But they do think that in the years to come, they're going to be a good mix of software and hardware, which is basically where Apple is now today, right? I mean, is earning a lot from services revenue. So if I had to speculate, I would speculate that Tesla would be a services company much earlier than Apple became a services company. So, and that would change the gross margin dynamics heavily in favor of becoming much higher gross margin business, much more profitable, and with more operating leverage, which already is pretty good. So they're industry leading already. They're industry leading in operating margin and things like that. But and they've hit those margins well ahead of expectation, or the expectation that they had set. So it could be very interesting to see this heads.
We are heading into the home stretch here. Going to wrap things up quickly. So just a couple more questions. Raw materials and chip shortages have been a problem. We've seen Tesla's acknowledged it's been a problem, but they seem to be able to solve it. They seem to be able to shuffle things around, whereas other manufacturers are like, but we're closing factories for 6 weeks, or we won't be making the Volkswagen, whatever, the Jetta for 6 months. Like, Is Tesla just better at this because they're not using old line thinking?
I'll caveat. I think yes is the answer, but I'll caveat by saying that their volume is lower than a Volkswagen, right? So they're not at that scale of making hundreds of millions or tens of millions of vehicles. Making, they're at like a million run rate right now. So what Tesla is doing is right now is agility. So basically, they're saying, okay, there's a shortage for the airbag chip, which probably costs like $2. So it's really low end chip. It's not available. Okay, can we go, and Takeda or whoever or Bosch, whoever makes it is not available. It's not available. Can I use another one? Can I change the firmware? Multiple chips, integrate them together, and then just use them instead of multiple of these other chips. So they've been doing a lot of agile thinking. They've been doing a lot of work with the supply chain. I think a lot of that stuff is agility. A lot of that stuff is also the lower volume. A lot of the stuff is also got to do with they being willing to pay more, because a lot of the chips that they use probably are higher end compared to some of the chips that the other cars use, just because of their design being more relatively new compared to others. So I think that's played a big role. I personally think that I can't believe that we will have a long-term shortage of airbag chips and this, seat belt sensor chips and stuff that we have always produced in very high quantity, and whose price have been falling constantly for several years or decades. I just think those should resolve. With respect to raw material, I think raw material should also moderate. Some of these things, they have a better position though, because, and I think the raw material side is an interesting one, because they're the only credible large scale EV maker. They've gone into these long-term contracts, which have actually helped offset some of the, absorb the price increases that other car companies would see if they need those batteries. Now the battery prices go up, but they have the suppliers absorbing some of that cost. Of course, in some cases they have got a sharing arrangement. Well, you'll absorb some and you'll absorb some, and things like that. But my comment would be that this setup is not a good setup for anybody trying to ramp their EV production today. This is a bad situation to be in, where things are not available. So raw material supply, raw material cost is highly variable, going up and down, and it's on the high side right now. So it's a bad situation if you're a Tesla competitor without scale, and that would include many of the OEMs which don't have scale on the EV side. They have scale on the ICE age vehicle side. So.
Yeah, so I have to say, I love agile thinking. So, I spent 4 years running a factory. And when I started doing that, I didn't know anything about running a factory. So if a customer called me and they wanted some impossible quantity of goods, I always said yes, and then just figured it out, because, it's a lot better when you sell stuff. And we did some of the Tesla things. Like we set up workstations in the parking lot, and we, wheeled and dealed for raw materials and did the things you could do. And it was a really interesting lesson in sort of, how you manage things. And I was making very simple products compared to a Tesla, but there were times where it was me in between sales trips, standing out there with any body I could round up, just making stuff. And, in some ways, I love that ethos at Tesla. One final question, Anirban Mahanti. Is Tesla undervalued? That almost seems ridiculous to say, but I've been wrong not owning Tesla for I haven't ever owned it, but I didn't really think about owning it until 2 years ago. And the fact that I don't own it is bad. I've lost a lot of money not owning Tesla. Is Tesla undervalued right now?
Yeah. So the one way to think about this is, if you look at the non-GAAP EPS, the earnings per share over the trailing 12 months, it's a tad over $5. So there's a company with real earnings, with real free cash flow, real factories, and stuff that people love. So all of those things are there. And then if you look at the PE, it's somewhere around the 200 range or under 200 range right now, because the share price is around 900 or something. So, you'd say, 200 times earnings for a company, for an automotive company is pretty high, which is yes. But no automotive company right now also has earnings growing at 100% plus, which is where Tesla is right now because of the stage of the business and so on. So you wouldn't value it like at 20 times earnings or 15 times earnings right now. You could value this if it hits steady state at some point at 12 times, 15 times earnings. But this is a company with the production goals of 50% plus increase over the next 10 years. That's a pretty crazy goal. And there's a lot of leverage and software and things like that we are not accounting for. So if you consider the growth trajectory and how the margins could go up, you could claim that this is actually undervalued. I own the shares. I've owned it for many, many years. And I continue owning it largely because of that reason, that I think this is one of those very interesting scenarios where a company which to some people looks undervalued, looks overvalued to others. And this is what I call a highly debatable stock, a stock which has got a lot of bears and bulls on its side. And those tend to be, if they work out, to be great examples of holdings that you want. So, and I think the optionality is not priced in, is what I think personally.
And for full disclosure, I did buy some Tesla in my son's custodial account, but he puts like 30% of his Wendy's paycheck in every couple of weeks. So it's like $75 worth of Tesla. Like fractional shares are awesome because now my son can track a company that's really interesting. And honestly, if you're 18 years old, putting $75, $50, whatever it is in every couple of weeks is really going to be a lot of money when he's older, which is an important lesson for any of you student members who are watching. At 7 Investing, we offer an $84 a year student membership. So if you're a student, a full-time student, you log in and you have trouble signing up for that, just hit us up at info@7investing.com. That is how you get in touch with us. So once again, info@7investing.com, or if you want to follow us on Twitter, you can do that. That is @7. That is the number 7 investing on Twitter. I will tweet out. I actually did a Fox Business podcast, a pretty big show, really interesting one this weekend, where I talked about multi-level marketing. That's not really a stock market topic, but it is really interesting. And a lot of people end up sort of getting sucked into those companies. And basically, I gave you a big red flag, not even a yellow flag, a big red flag on any of those companies. Thank you to Anirban Mahanti. Thank you to JT Street. Thank you, Sam Bailey. We will be back on Wednesday. Thanks, everybody.